Welcome back to 15 Minutes of Finance. This is the tax plan, where I help you keep more of your money. Today's topic is charitable contributions and whether or not your contributions to a qualifying 501c3 will be deductible for you in the tax year that you're contributing. Now, before we get into the specifics of charitable contributions and talk about the deductibility to help you tax plan, it's important to understand what type of deduction a charitable contribution is. And on your tax return, there are several types of deductions, and they behave a little bit differently. There are some deductions which we refer to as above-the-line deductions, and that basically means that we deduct those deductions, to keep using the same word here, it's the correct word, before arriving at our AGI, or our adjusted gross income on our tax return. Some of these are student loan interest deductions, contributions to a standard IRA. There are a couple other ones. Those are some of the more common ones that people are familiar with. And so charitable contributions, which means an amount of money that you contribute to a qualifying charitable organization, they're what are referred to as itemized deductions. And there's a lot of taxpayers who don't quite understand what type of deduction that is or how that affects the deductibility. So let's talk a little bit about itemized deductions. A lot of people, especially if you've only ever had a W-2 job and maybe you're not yet a homeowner, you have probably never filed the schedule on your tax return where you claim itemized deductions. So itemized deductions are a series of deductions that, if added together, exceed the standard deduction can be deducted on your tax return. So the standard deduction is an amount that is given to all taxpayers. It's sort of a floor of how much you have to make to pay taxes. So for individuals, it's $12,000 and some hundreds of dollars for 2023, that the tax year we just filed for. I believe it's still under 13, but it's getting pretty close for 2014. Haven't looked up yet what the rate will be for 2025. It usually adjusts each year with inflation, but we're getting relatively close to $13,000 now for individuals. So we'll just call it a $13,000 deduction for this year and in future years, because it's closer to that than $12,000. So the standard deduction is a $13,000 deduction that offsets against your taxable income regardless of the rest of your situation. So if you have an $11,000 W-2 from a part-time job and you apply your standard deduction on your tax return, your taxable income will be zero. So we arrive at our adjusted gross income, then we deduct the standard deduction and we get to our taxable income that then we assess tax on and we figure out if you owe anything for the year. Okay. So the standard deduction is what you're almost always going to take if you have a pretty simple tax situation. And that's because it's given to everybody. There's not specific things that you have to qualify for it, okay? And for most people, it's above what their itemized deductions even would be, okay? So the itemized deductions are a second option that if your itemized deductions together exceed the standard deduction, you would then take the itemized deduction on your tax return. The primary categories, and there's a couple other random ones, but the ones that make up the vast majority of individuals' itemized deductions are real estate mortgage interest deduction. So if you own a home, the amount of mortgage interest you pay each year, that's reported to you on a 1098 form. State taxes, okay, so that's real estate taxes. If you own real estate, that's state income taxes that you paid throughout the year on your W-2. Any other state-related taxes, I believe the tax portion of state DMV fees for your car are also part of that. Not the registration fee, but the state tax fee is part of that, okay? Medical expenses, and there's a caveat to that, and then charitable contributions. Those four make up, this is not a real number. I haven't researched this, but I would guess 95% of the general population's itemized deduction. That's what makes up your itemized deductions. So you could see how if you just have a standard job, you're not a super high earner, and you don't own a home, there's no mortgage interest and there's no real estate taxes, none of those other categories are likely to exceed just shy of $13,000, right? So you would have to be extremely generous and give a lot to charity, or you would need to have extensive medical complications that required medical expenses that put you in the itemized deduction bracket. The medical expenses get even more complicated because there's also a floor for them where you could only deduct medical expenses on your itemized schedule for medical expenses exceeding 7.5% of your AGI. So if I make $50,000, let's just assume that the number was 10% for the purpose of this math, so you can understand. So if I made $50,000, my adjusted gross income was $50,000, I would only be able to deduct medical expenses that exceeded $5,000, right? 10% of my AGI. So it's 7.5%. It's a little lower. So that would be, I want to say, $3,750. So if I spend $5,000 on qualifying medical expenses and my AGI is $50,000, I can only deduct $1,250 on the itemized deductions. And then altogether, those itemized deductions would need to exceed just shy of $13,000 for me to take the itemized deductions anyways, because the standard deduction would be higher otherwise, right? So hopefully that helps crystallize it for everybody. So you take your itemized deductions, you add them all together. You can't pick and choose. You either take all your itemized instead of the standard deduction, or you don't get any of those deductions that I just listed, and you get the standard deduction. Okay, so that's how that process works. So there's two things that made it much more common even in recent years that people take the standard deduction. One of them is the 2017 Tax Cuts and Jobs Act passed under the first Trump administration that functionally doubled the standard deduction. So when in 2017, when the legislation passed, it was just shy, I believe, of $6,000. It was like $5,900 per person. It went up to $11,800. I believe my numbers are right. It might have been roughly 6 and gone up to 12. Okay, and then it's gone a little bit up each year since then. So the standard deduction doubled. So for a married couple, for example, who get a double standard deduction, because there's two of them on a married filing joint return, their standard deduction in 2023 is just shy of $26,000. Okay, so that's substantial. The other reason is that they made a specific cap on one category. Okay, so they put a cap where the state taxes portion of itemized deductions is now capped at only $10,000. So no matter how much you've paid in various state taxes, you could only ever deduct on your itemized deductions $10,000 of that particular category. Okay, so because of those mainly two reasons, there's some others, but mainly for those two reasons, it is now far more likely that the standard deduction will be advantageous for your tax situation. So very few people have to worry about itemizing. But that leaves us in the topic today, in the central question today. Well, if I can't itemize my deductions, am I going to be able to write off my charitable contributions? Because you just told me that charitable contributions are an itemized deduction, and I can only itemize my deductions if all of them together, I can't pick and choose, all of them together exceed, if I'm married, almost $26,000. And the short answer is that's correct. So we're going to talk about some specifics here, but that is the overall umbrella kind of understanding to understand when you're giving charitable contributions, okay, is that you're only going to be able to deduct charitable contributions given if you itemize your deduction. So a lot of people, they'll send me their receipts from their church or their library or whatever organization that they gave to and say, oh, I know these are deductible, right? Charitable contributions. And a lot of times the letter you receive from most 501c3s, charitable organizations that recognize your giving throughout the year say, you should provide this form, whatever, to your CPA or your accountant because it might be deductible to you. They usually offer some sort of a letter to help you keep track and to validate the amount you gave. So then you go to your accountant and you say, hey, here's the amount. It's verified by the organization. This is deductible, right? And the answer is yes, it's deductible, but only if you're itemizing deductions. And so that really blindsides a lot of people, assuming, they gave they make $100,000. Maybe they're a more traditional Christian who follows kind of the 10% tithing rule. So they gave almost $10,000 to the church throughout the year, and then they don't get a deduction for it. Not that that's usually the primary reason people give, but it's definitely a consideration, expecting, oh, I'm at least going to get a little bit of a tax incentive for this. That's a cool bonus. And then they don't get that. So it is important to understand that, so that you're not disappointed or your tax calculations are incorrect because you've been assuming that you're going to get this deduction that isn't actually available to you when you file your taxes. Okay, so but there are some caveats. So first, let's talk a little bit about kind of what counts as a qualifying charitable contribution. One, it has to be to a qualifying, it's called a 501c3, which is just the part of the tax code that explains the tax status of charitable organizations, okay, nonprofit institutions. So if they meet the requirements to organize themselves as a 501c3 under that part of the tax law, that makes them an exempt organization, and it means your cash and oftentimes as well property contributions to these organizations are legitimate itemized deductions for you and any other donors to them throughout the year. Okay, so it has to be to a qualifying 501c3. Most churches, educational organizations, anything like that, most of them are 501c3s, but it's just always a good idea to double check when you're giving. And also, usually these organizations will advertise. So, if a church asks for tithe or an organization fundraises, they'll usually say all of your contributions are, deductible, to the extent you itemize whatever. We are a qualifying 501c3. So most organizations understand the incentive and they will kind of advertise in front of you that way. And there's not really any guesswork in figuring out if they are a 501c3. The second requirement is that it has to be directly given to the 501c3. I can't. So let's come up with a hypothetical. So I'm part of a church. Okay, so it's called Church One, and we have a fundraiser for a widow who just lost her husband and she's trying to keep her home. And so our church is fundraising to provide a lump sum payment to help with the mortgage for a couple months while this woman gets back on her feet. Okay. If I come to you and I say, hey, I'd really love if you gave, I know this person, personally, it'd be a really great cause. And you give me money to give to her and I put it into the church with your money, you don't get a deduction for that. So I know it's a little technical, but you have to directly provide money to a qualifying 501c3. It can't be looped around third parties or indirectly get to the ultimate organization that makes it deductible. It has to be money directly given from you to the organization. Number 3 is it can't be any other organization, even if it's supported by a 501c3. So it's sort of a similar rule to number 1, but I just want to clarify. If my church starts a GoFundMe, and then you give to that GoFundMe, if you gave through GoFundMe, that is not a qualifying charitable contribution because it went through a fundraising independent platform. So it has to go directly to the organization. So there's lots of times where people give through some sort of fundraising event. A lot of times that's created by just an individual. Hey, help raising for my friend to pay for school or medical expenses, or hey, this just happened. This person's in my neighborhood. We're raising some money. Their car got stolen. Those contributions, good on you. That's very generous. Just understand that is not a qualifying charitable contribution, even though it's to a charitable cause, because it does not go, even if, shared by a church or a school or whatever, it's not deductible unless it's directly given to a qualifying 501c3. So what if you're in the position where you don't itemize your deductions because added together, they do not exceed the standard deduction, but you give a lot to certain qualifying 501c3 charitable organizations? There's one really important caveat to understand, and that is the carry forward principle. So if you give money to a charitable organization and you have qualified charitable contributions, but in this year you do not itemized because it would be lower than the standard deduction, the IRS allows you to carry forward unused charitable contributions for up to 5 years from the date that you gave them. Okay, so if I give money this year, 2024, right, I can carry forward all the way to my 2029 tax return. So let's say I give $3,000 each year, right? $3,000, not enough to push me over the itemized limit. Carries forward. 2025, I give $3,500. Okay, still not enough. The next year, I give another $3,500. I'm at 10 grand now. I'm almost there. Still, standard deduction is better. Then so we're 4 years down the road, so it'd be 2028. I buy a home, and now I have mortgage interest and real estate taxes, and my itemized deductions are 28 grand. Let's say. Well, now I have 4 years of charitable contribution giving that has been carrying forward. So now I add those charitable contributions. They all qualify. They're all legitimate. None of them have been taken. They've all been carried forward correctly. Then that means now in that year, I'm going to add that $10,000. And now my real itemized deductions for 2028 are $38,000 because I had $28,000 in itemized, but then I also have all these carried forward charitable contributions. So that makes it really important to understand two things. Just because you can't deduct it in the year of giving does not mean you'll never get a tax deduction for it. And two, always report them to your accountant, even if you don't itemize, and make sure that they're reporting it as an itemized deduction on your tax return. Even though you won't itemize, somewhere in your return it should be noted that there are charitable contributions that are carrying forward. Okay, so it's a very important thing to remember because it can definitely add up over time, and then you can stack them, so to speak, so that now when you do qualify, you have years and years, up to 5 of charitable contributions that have been continually rolling forward because you haven't taken them up to that point in time. All right, guys, it's a simple one today. There's really one topic we wanted to cover with this one. It's just the tax rules for charitable contributions. Remember, you have to itemize your deductions to take the charitable contribution deduction. It's one of your itemized deduction categories, but if you can't take it in a given year, remember it does carry forward for up to 5 years, so make sure you're always telling your accountant and reporting to your accountant how much you're giving each year in qualifying charitable contributions because they may add up and make a difference down the road. As always, we hope you learned something, and please reach out to us with any topics you'd like to hear covered. Comment on the video any questions you would like answered. Otherwise, we'll see you next time, and as always, invest early, invest often.